My name is Rich Keevey, and I'm the director of the Policy Research Institute for the region. And I'd like to welcome you today at the Woodrow Wilson School for today's forum, Regional and National Financial Crises, Roots, Results, and Responses. Before I get going, just a couple of housekeeping directions, if you will. We do not intend to take a break between Congressman Leach's presentation and the panels. We have found it leads to more confusion than it's worth. So anytime you need to leave, please do so. Our first major break will be at lunchtime, in any case. One can hardly imagine, but at the same time, note that this financial crisis is affecting this region very intensely. The details of the subprime mortgage and other financial crises facing our nation are murky and very difficult, I think, to understand and to explain. One day the solution is buying up toxic mortgages. The next day it is investing billions of dollars in a selected number of banks. One day the administration's proposal consists of a two-page document. For the Secretary of the Treasury, the next week there's a 435-page document from Congress. The stock market seesaws back and forth between huge losses, huge gains, and sometimes only within hours. And no one seems to be able to pinpoint exactly why. Today's forum brings together experts in the financial arena to explain what has happened, analyze the causes, offer solutions to today's problems, and make recommendations for future actions. And I can think of no one better qualified to begin our discussion and to address the role, or perhaps maybe the failure, than former Congressman Jim Leach. Jim has served in Congress for 30 years and chaired the House Banking and Financial Services Committee for 6 years. Today, he is a visiting professor here at the Woodrow Wilson School. Following Congressman Leach, we have a panel of experts who will discuss the macro and micro level motivations and decisions that has led to the current spread and interconnected crises that have resulted, in large part from inappropriate mortgage-related investments, but has also stretched into our banking and insurance arena, and to say the least, has left most of us confused. Our second panel will examine an entirely different aspect of the financial crisis facing the region, one not as familiar as the mortgage crisis, but one nevertheless that has caused similar threats, particularly pertaining to debt financing and public investment portfolios of our state and local governments. Auction rate bonds, derivatives, interest rate swaps offered opportunities for better than average returns, but also exposed public agencies to risks that may not have been fully considered. Our panel of experts will analyze how these errors were made and offer recommendations on current and future practices. Our luncheon speaker is Alan Blinder, professor of economics and public affairs here at the university and the former vice chairman of the Federal Reserve Board. His talk will be entitled, "Putting the Pieces Back Together." Sounds like he has an answer. Alan has written extensively on the subject of home foreclosure and has recommended that the government should buy the at-risk mortgages below face value, a plan similar to the strategy of the Homeowners Loan Corporation that was set up during the Great Depression. Dr. Blinder, as you know, is uniquely qualified to discuss the current financial crises, and we are certain that he will have interesting insights. And finally, Susan Wachter, professor of real estate and finance at the Wharton School of the University of Pennsylvania. She's also a former assistant secretary for policy and economic development at the U.S. Department of Housing and Urban Development. And she will give our last presentation entitled, "Understanding the Source of the Ongoing Financial Crises." With that said, I welcome Congressman Leach to begin what I am certain will be an engaging and informative day. I can't wait to get started. Congressman, please.
Well, thank you very much, Richard. First, I'd like to note that Rush Holt is with us, and
having served with Rush, I will tell you that I don't think there's another congressman in the country held in higher regard. And I was astonished to learn that 38% of the people didn't vote for you, Rush. But oddly enough, because we went through an electoral process, Rush is the Congress's leading expert on how elections are run, among other things. And I remember once he came to me and asked me to co-sign a bill with him, and I said, "What is it about?" And he started to tell me, and I said, "Stop. I trust your judgment totally." And in any regard, I'm honored to be with you, Rush. I've been asked to comment this morning on the financial meltdown and the legislative and regulatory framework. And my intent is to address four whats. What has happened, what is the legal framework, what should and should not be done, and what to expect. And first, to paraphrase a former Secretary of Defense, there are things that we know, things we should have known, things we're beginning to understand, and things we'll never grasp. And an economy is in a sense, much like the political system. That is, it's based on confidence. And when it's shaken, disappointment and skepticism reign. And once trust is shattered, it is very difficult to regain. The optimist assumption at the moment, by the way, is that next year will be a downturn and that 2010 will be an uptick. But at the IMF, for example, they're predicting a 4% GDP retrenchment in the year 2009. That is very significant. Now, the only optimistic aspect of that is that economists are not always right. And international economists are seldom right. Well, not seldom, but more likely to be less right. But it's a very sobering time. And I will tell you, as someone that sits here in a lunchroom every other day with a group of economists of world note, it's been very impressive to me to hear on an almost weekly basis different assessments and based upon comments like, well, I think the end of the world is coming, to, well, I'm more optimistic this week. I mean, people really are looking at this in abstract kind of ways, but more importantly, and again, a little bit like politics, one can reach personal judgments based on abstract notions or personal beliefs, but the judgments that matter are the sum total of how people do things. And how people do things is a matter of people and not one's own judgment. And so if we can resurrect confidence, a lot of things can unfold. If we can't, it's going to be more difficult. In general, the genesis of the economic mess we're in really begins with the lack of savings. And the twin deficits, and everybody in this room has heard about the twin deficits. You got the deficit in public policy, you got the deficits in the private spending, and everybody has heard at some point there'll be a day of reckoning. And it's just possible that the day is beginning to be reckoned with. In more intermediate terms, it began with in politics, with some decisions involving a war, the first war in human history that has been financed with tax cuts, which is a rather novel concept. And then a war and other matters that frankly have eroded confidence in the American political system to a greater extent than has ever occurred in the history of the United States. And then we had the subprime meltdown, which has now moved into other financial instruments. And the abstract big picture is that America's image in the world came to be in great disrepair politically, but at the same time the political disrepair hit, there was still awesome respect for the brilliance of Wall Street. And suddenly when you have an undercutting of Wall Street, it's the dual opinions of America, our politics and our markets in the eyes of the rest of the world have come under a great deal of criticism. It is conceivable, and again, in the last 2 days, you've heard everyone suggest that this has been a historical election. It's hard to apply the word historical to an event that's just occurred a day before. But in relationship to American history, it's clearly historical in terms of the notion of a man of a different colored hued skin. But it could also be historical in terms of regaining confidence of America in the world. But that we don't know, and it will just take some time to tell. But that could have economic as well as political ramifications. And I say could because sometimes the best and the brightest don't succeed. I tell students from my state of Iowa, for instance, that the smartest president of the 20th century was probably an Iowan. His name was Herbert Hoover. And he was the least successful American president. Possibly the least smart American president was the most successful, and that was Franklin Delano Roosevelt. But he had a brain trust, and obviously he fit the times very well. I personally think the best and the brightest are less likely to err than the less bright and less bright, but still, again, only time will tell. In any regard, the consequences of our financial problems are only beginning to unfold. And it could be that the transfer of wealth that we've been doing for the last decade or so, of literally spending 6% more than we produce as a society, will come to an end because outsiders are going to refuse to finance us to the same degree, and insiders are going to be more prudent. And so you could have a circumstance where insider contractions of credit, and people are kind of looking at the big banks, but if you think about it, the great credit expanders in America are credit cards. And today people are suddenly suggesting that credit cards are in difficulty. That means they're going to be less likely to be offered, and restraints are going to be much more difficult. And people are losing trust in the American capacity to deal with credit. And that could have huge consumer implications as well as public finance ones. So I think there is probably little alternative to a certain degree of belt tightening. And it probably means that the only institution of American society, public and private, that has the capacity to expand, although implications for inflation may come with it, is the United States federal government. And so I personally believe that there is a very real possibility that what is being predicted as $1 trillion deficit next year may be an understatement, and it could well go higher. There is a huge loss of confidence that began with the American mortgage market, where a number of factors came to play, not the least of which was a somewhat easing of monetary policy that is now coming under some review and some rebuke, and then a substantial and greater reduction in standards, all for somewhat good reasons. Everybody wants Americans to be able to own a family home. And so there was some good intent behind all of this, but lax standards do produce problems at some point in time. And when it's coupled with an economy that stopped producing jobs, an economy that stopped producing higher incomes, and financial instruments that were designed to be welcoming at the early stages and more difficult at later stages, you have a problem that got greater. And it got greater also by an aspect that isn't so happy. We had a real spike in mortgage fraud, particularly in the inner cities of the United States of America. And if you take a bundled set of products and only a small percentage fail, and if they fail badly, it has real reverberations because these products got sliced and diced and they got leveraged. And so if you take out, let's say, 10% of a set of products losses, that may seem like, therefore, the total package is worth 90% of value. That isn't so bad, but actually it got to be worth a multiple factor less than that. And so these great packages of mortgage products that we sold around the world came to have substantially less value, and we still have no idea what their value is, and that is what the next year or so is probably going to be all about trying to figure out. In any regard, Wall Street lost its moorings when Elm Street lost its values. And then you have this whole issue of the subprime problem suddenly ticking into other markets. And everybody's heard, and there are probably some economists in this room that know how these things work to a far greater extent than the rest of us normal people. But these words like swaps and derivative products came into being, many of which are designed to reduce risk and shave costs in the system. By the same token, they came to enlarge systemic risk in general. And so you have this concept that in notional terms, at one point there were well over $60 trillion of what are called credit default derivatives sloshing in world markets. Today it's believed to be maybe 45 to 50 trillion. No one's exactly sure. This is a rather extraordinary phenomenon. A lot are involved in parties and counterparties, and when people talk about notional terms, because the word trillion is a little difficult to understand, when meted out or netted out between parties, these values are reduced substantially, and sometimes by over 100-fold. And so one of the great issues is whether one has the capacity to clear these products, particularly in stress times, and I'll get into that in a minute. But all I would say is that Congress has moved, in one sense, in a very majestic way with a $700 billion program designed for a particular purpose. We're now learning that particular purpose that Congress voted on, which was to clear the world of as many as possible of these mortgage instruments, may not actually be used for those purposes. And in a way, that's kind of positive in the sense that people are adjusting to the circumstance and kind of feeling their way along. And you have one of the purposes now, some of it has been expended to shore up bank balance sheets. Maybe all of it will be used that way. Maybe some will be used in other ways. But the only thing that I think is a surety in the short term is that when facing a financial abyss, the Fed will always opt for reductions in chaos. And so it likes to suggest that it doesn't want to intervene in free markets, but it always will if it looks like there's a systemic implication. And Congress generally will opt for deficits to spur economic growth if you have a downturn in the economy. Now, that isn't an absolute surety, as the Fed circumstance is more so because you could have a reaction. For example, in the next election, if things continue to weaken further, you might have a reaction and get a very conservative Congress. And that's a conceivable possibility. And one of the aspects of that is that the new Republican Party is a party without a center. And so the reaction, if you shift gears politically, could be an exceptionally conservative reaction. But at least for this Congress, I'm very confident that one is going to move in the direction of substantially increasing the deficit, partly because of programs that will be increased and partly because of less revenue coming in. And then you have the natural thing happening, because some of you are with state and local governments. If the government of the United States moves to bail out Goldman Sachs, I mean, we have $25 billion offered Goldman Sachs. Isn't every state in the country going to say, we've got some problems with our bonds? Isn't every community going to say, we've got some problems with our bonds? Isn't every state going to say, we've got problems with Medicaid? Shouldn't the federal government pick it up? Aren't big and established American enterprises, for example, Detroit, going to say, the auto companies need money? And once you start down this road, it is really hard to stop. And equitability becomes one, if someone else got some help, why shouldn't the next person or the next institution or the next line? I'll tell you, the other day in this room, a chap who has an office around the corner from mine here named Paul Krugman had a celebration of winning the Nobel Prize for Economics. And near the end of it, and I really bit my lip, he was asked, "What are you doing with your money?" And Paul said, well, and this is the wise thing to say that you're wise, well, I've had a lot of it in cash these days. But then he said, and I found this remarkable, I've been buying California bonds because I am confident the United States government will not let California go. Well, he might be right, but he might not be. I just think that was a really extraordinary bit of assumption. And I think he was right in the sense that from an economist's point of view, it was a wise thing to do. But I'm not sure there's going to be the perfect political will. And if there's a political will to help this year, will there be a political will next year? I don't know. But when he said California, I mean, all of you can think New Jersey. And you have similar kinds of dilemmas in this state. I come from a state of Iowa that has the best finances in the country, or one of the best. And the governor announced 2 months ago what terrific shape the state budget was in. And then last week he announced what lousy shape the state budget was in. And so this is something that's really a national phenomenon. Anyway, also Congress, and it's a social imperative. If you help people from the top down, you just about have to try to figure out ways to help people from the bottom up. And so in the mortgage market, it presumably means how do you stabilize mortgages, and that means how do you deal with mortgages and potential foreclosure, and does the government try to help? Next point I want to get at is about regulatory reform. And in theory, there's no need for anything to happen. More important than any regulatory reform is judgments that are applied. But in fact, we could have a better system. And so we have to be thinking of doing that. And that really the fundamental challenge is to rein in what I used to call in my earlier life as a congressman the lure of leveraging. And so I'm going to go down some structural suggestions, many of which will seem kind of obscure because they involve the Washington lexicon of letters instead of names. For example, I think the case for merging the SEC and the CFTC is profound. The SEC is the Securities and Exchange Commission. The CFTC is the Commodity Futures Trading Corporation. The former has a deep legal bench. The latter has extraordinary responsibilities and almost no people. In the case for merging them and also infusing a lot of economic talent is absolutely profound. I think economists in America should have a for rent sign on their shoulders. The government really needs them. The second issue, I think that the Federal Reserve has to be given umbrella responsibility in a safety and soundness way for all major American institutions that have systemic capacities to influence the system, and that means investment banks and large insurance companies. I mentioned, by the way, economists because in regulation, with the exception of the Federal Reserve, virtually all regulatory bodies are loaded with lawyers, and lawyers are very important for regulation. But there's kind of a left side and right side of the brain syndrome problem. Lawyers are good with words, economists are good with numbers, and the financial issues that we're dealing with are numerical more than they are linguistic. And that's one reason why the Fed should be the leading institution and why we need far more economists on the regulatory side. Point three, and this is really obscure and surprisingly important, there is an institution that is existent in 6 states in the United States, and only 6 authorized by federal law, called industrial loan companies. You might say, what are they? We call them ILCs, and they are institutions granted act like banks, but they can be owned by commercial enterprises. And they're not regulated at the national level. And so virtually all your investment banks had ILCs doing banking functions for them so they could escape Federal Reserve jurisdiction. And my own view is that these ILCs ought to be abolished or at least reformed and come under something called the Bank Holding Company Act so that they cannot allow commercial firms to do banking functions. You might say that's esoteric, but the quasi-failure of Merrill Lynch is not esoteric. And Merrill Lynch was operated as an ILC, its banking function principally, and it did not have the oversight of the Federal Reserve. The fourth point I would make is that I think the Treasury's got to be upgraded on the regulatory side, and what are called government-sponsored enterprises have to come under total Treasury regulation, as should two offices within it, something called the Comptroller's Office and the Office of Thrift Supervision ought to be combined. And one of the things that happens in the regulatory front is that there is competition between regulators and choices that financial institutions can make on which regulator to choose to be under. And you end up with kind of a regulatory arbitrage. For example, if Rush were to run a financial institution and wants the least regulation, which would be his natural instinct, he will choose the regulator that is the least intrusive. And in making that choice, that's not necessarily advancing the public interest, it's advancing Russia's interest. And I think we have to do more to diminish what is called regulatory arbitrage. The fifth point I'd make is that everybody's talking about rating agencies. No one's really put a lot of thought to them, and it's an amazing phenomenon from a public point of view that it's never been much recognized that rating agencies are paid by the people they rate. And every time one of these institutions they rate makes a public issuance, they're paid again to rate the issuance. And that is an obvious conflict of interest, especially when you have a little competition between rating agencies. Now, I personally think it's terrific that the private sector has developed rating agency motifs, but you've got to be very careful at the public policy level to rely much upon them. And then I think they've got to come, rating agencies, before Congress in a much more rigorous way of oversight. And we have something called the Humphrey-Hawkins review process, and I think it's part of that they ought to come in. The next point, the sixth point I'd make is that on the swaps and derivatives issue, the Federal Reserve should really move as forthright as possible on developing a swaps clearinghouse. Based, frankly, on a provision I put into the federal law. Since 2000, the Fed has had this right to do it. It's only been in the last month or two that it's moved in that direction, and it's very important. There's also, in a good sense, some competition coming in the private sector because of this meltdown. Clearing facilities are being considered in 2 European exchanges and 1 Chicago-based exchange as well. And I think it's really critical to have processes by which, if you're going to have swaps and derivatives, that they be cleared, and that is probably more important in dealing with the dilemma of size as almost anything else. Because again, one has to stress, when you're talking credit default derivatives and you use volumes of $60 trillion, that's larger than the GDP of all countries in the world combined. And so if you don't have a process of being able to clear easily, you've got a real dilemma. The next point I'd make is that the Congress actually, in a recent statute, and the regulators have been moving in this direction, approved what might be described as bookkeeping gimmickry. That is, they said that banks don't have to write off instruments that they hold that have diminished value. Well, that is really bizarre. And I would really caution, if you're going to use give institutions a right not to write off things, you've got to keep it limited in a time circumscribed way and limit to the state of a period of emergency, because the real pressure should be on financial institutions to go to capital markets and raise more capital. And banks don't want to because it has the effect of diluting stock. Well, it's really bizarre that banks think they don't have to dilute stock when borrowers of banks do, when they get in difficulty. Banks say, raise more capital, or we're not going to lend. Well, banks to lend have to have more capital. And we have allowed something in banking that is absolutely bizarre, that the largest American banks are under much weaker standards than the smaller ones. And so this problem that we have is really in inverse proportion to size, and it is very clear that our largest banks have to have a greater capital base. Which brings me to the next point. We have to understand that standards in regulation are in the national interest. And you might say, well, that's kind of a bizarre thing to say because it's self-evident. But many of the standard setters in the United States and around the world have been erratic, and that the interests that they have been propelling have been the interest of markets or commerce, not necessarily the public interest. But the fact, as indicated by this crisis, is that the public is on the line when mistakes are made. And so regulators have to recognize that their first concern cannot be price-earning ratios. Their first concern has to be what happens in the event of a stressed environment. And so you can have one set of rules when everything seems to be going well, but if you're not prepared to have rules when things get worse, you're not serving the public interest of the United States or the rest of the world. Let me give a couple of examples. 3 years ago, a major New York bank determined, in a very undercapitalized bank, relative to its assets, that it would buy back $20 billion of its stock. And for anyone in finance knows, you can really gin up price-earnings ratios in the short term with stock buybacks. By the same token, that bank, when it got in a little difficulty, had to then resell stock at vastly diminished values, much to its embarrassment. And I think the bank made a mistake, but I think it's even more preposterous that regulators allowed the bank to buy back that volume of stock. In Europe, under something called Basel II, which is an agreement by which the European regulators do things, we've moved in the direction of what is called risk-based analysis. And this is all very modern and very appropriate in all regards but one. If you put everything on risk-based accounting instead of traditional or old-fashioned leveraging ratios, you can kind of gin the analysis because you can put into the matrix of your mathematical modeling anything you want. And it ends up that the banks that were fearful of this approach have ginned it to such a degree that they've been able to do far more leveraging than they had before under a very traditional way of doing things. And for example, on the issue of mortgages, under Basel II, European banks did not have to keep any capital set aside against mortgages they bought, and that made a great incentive to buy mortgage products. No American S&L can operate that way. And I think regulators got far too loose, far too lax with their standards, and they ought to keep risk-based approaches in place, but they also have to complement them with much firmer leverage ratios themselves. And I think that you'd have a much better system. Finally, let me just conclude with a couple of things of what Congress shouldn't do. And I'm going to raise some issues that are not in the public domain, but are, in my view, extraordinarily important. One is something called UIGIA. How many in this room have ever heard of UIGIA? Great. UIGIA means the Unlawful Internet Gambling Enforcement Act. And I'm a little personal about it because it's an act that I proffered. In fact, it was the last act I passed as a member of Congress. And what it does is it's an enforcement act for American law related to internet gambling. And what it says is that no financial institution can use a financial instrument such as a credit card or check to be transferred to an internet gambling site offshore. That sounds fairly trivial, but between the mid-90s and the mid part of this decade, internet gambling had increased about 800-fold in the United States, and about 6% of college kids were doing internet gambling, about 10% of boys on campus or men on campus. And that was increasing at this really extraordinary rate. I think it would have been much higher if this act had not passed. Passage of the act within a year meant that those statistics went from 6% on campus to 1.5% in a one-year period. But if you don't block internet gambling at its inception, it will come to take over this country. And I saw a study the other day that 13% of poor people in America gambled principally by buying state, what do you call them, lottery tickets. But internet gambling is the crack cocaine of gambling. And some of the studies indicate that gambling in America will increase 5, 10, more than that fold within a generation if we authorize internet gambling in the United States. And so internet gambling is really a predatory savings technique. And it will do far more damage to potential homeowners than any predatory lenders have ever thought of doing. If one goes to a gambling culture, America is very, very much in difficulty. That particular act was eviscerated in the House Banking Committee 6 weeks ago. It hasn't come to the House floor, but I would caution Rush that it's about to come, and that one should be very, very cautious about allowing that to take place. The second caution I would have relates to a bill that bears my name called the Gramm-Leach-Bliley Act, which is a bill that modified but did not repeal the Glass-Steagall Act. And what it modified Glass-Steagall was it allowed banks to do investment banking and insurance by widening the competition within these three industries, but it didn't reduce the regulatory framework, it actually increased it. It's a re-regulation rather than deregulation bill, and it says that if a bank does an insurance function, it gets regulated by that part by the insurance folks. If it does a securities function, vice versa, and then if an insurance company does a banking function, that function gets regulated by banking authorities, et cetera. It also added the greatest privacy protections in the history of the Congress. In terms of this crisis, it saved the taxpayer more than a little because it has allowed several large, in fact, 3 large banks, one British, to take over troubled American investment banks, which they otherwise wouldn't have been able to do. And that would have been put in the public domain instead of the private. And it also, there are some other provisions that have been very helpful to small banks. But what I would stress that a lot of people don't understand, that it didn't change the most important part of the Glass-Steagall Act, which maintains in statute, and that is whether a commercial bank can make direct investments in American commerce. It's called mixing commerce and banking. And like cicadas, changing this precept comes back in Congress every few years. And I spent 5 years of my life trying to ensure that it was kept under wraps. But the point of it is there are insiders that try to move in the direction of allowing banks to merge with commercial enterprises. And so the issue for the public is, do you want to have a Citicorp able to unite with a GM, able to unite with a Sears Roebuck, able to unite with let's say a Microsoft as one giant corporation, which is the concentration of American ownership? which to me has virtually no implications for economies of scale and lots of implications for moving America to mega corporations at an extreme of what the Japanese model is. They call it the karetsus in Japan. And I don't think it fits America at all. But I will tell you, your Treasury Department pushed it as part of their plan of reorganization this spring. There are members of Congress that are great advocates of this. And I can't think of anything that would be less helpful to the American economy than a greater concentration of ownership. And that if you had that model, you would have enormous difficulties. Let me just conclude with a couple of thoughts on where we go from here. The bad news is it strikes me that the likelihood will be that America will have a very difficult year and that we're just beginning a process of unraveling some of these difficulties, and the ramifications will not be felt for months to come, or the fullness of them. The good news is that the government has a lot more quivers in its arrows in its quiver than it's ever had, and that there is a real willingness to act. But as Katrina has shown, money isn't enough. I mean, if you look at the New Orleans situation, it is astonishing how much money has been put forth and how little its effects have been. And so it does matter how you do things. The Fed's assumption, and this is incredibly important for the country to understand, and we possibly have the most appropriate Fed chairman in American history because he is perhaps the greatest student of the Great Depression in the American economist field. But the Fed's assumption is that the lesson of the 30s was that the government did not act on a timely fashion and with enough force, that it basically held back. And so this Fed wants to act forcefully and promptly. And the analogy is to military strategy. And that is, everybody kind of knows that every generation there's a military strategist that says you need overwhelming force before you act. I remember in the Civil War there was a great Confederate general named Nathan Bedford Forrest who said you have to be fustest with the mostest. And in this generation, it's Colin Powell with the so-called Powell Doctrine, an overwhelming force doctrine before you pull the trigger. Well, the Fed is trying to apply this to the economy. They want to have overwhelming force, and they want to make it clear that symbolically we will be prepared to do anything that we can. And so this Fed chairman is not an acolyte of Ayn Rand, nor is he a brownie. And that is good. The bad news is that frankly, government may not be powerful enough or nimble enough. I mean, we're talking many trillions of dollars of problems, and it's not clear that it can act as fastly and deeply and thoughtfully as it should, but it's surely not going to stand on the sidelines. And so the recession has been entered. The only question is how long, how deep, and how we're going to come out of it. And the only thing I will say is that every suggestion I have heard made of doing something, I have really been anguished about. By the same token, the only thing worse is probably to do nothing at all. And that's the dilemma we're in as a society. Thank you very much.
We have time for some questions. We have mics here on the left and on the right. So if you would just raise your hand, we'll get your mic up there. Any questions for Congressman Leach?
Yes, sir. Yes.
You make a comparison with the situation in the 30s. And how Mr. Bernanke, Chairman Bernanke, is perhaps best qualified, based on his research in that regard, to address the situation today. There's been some discussion that says that there's some significant differences between the circumstances we're facing today and what we were going through in the 30s. Could you address what those differences might be and how the model of the 30s may or may not be as appropriate to apply to today's situation.
Well, I don't want to be beyond my field, but I will say that we've lived in an era in which change is the hallmark, and change that accelerates is an even greater hallmark. And so we are radically different than we were in the 30s. The economy is much different, and the intertying with international affairs is of a much different dimension. The intertying with international economics is even more so. Now, one of the things that didn't cause the 30s was protectionism, but one of the things that deepened and lengthened the Depression was protectionism. And so you have a model there that is somewhat worrisome, and frankly, as someone that helped head a group called Republicans for Obama, I am very optimistic about the next administration. But the grounds for some concern is that there is a real protectionist sentiment brewing in Congress. And there's some partisan dimension to it. It's a little more Democratic than Republican, but Republicans are moving in that direction too. In fact, the change in the Republican Party used to be a party of a kind of a business, and now it's more social issue parties, and a lot of the social issue people are somewhat protectionist. The Democratic Party, of course, is tied to organized labor that has gotten very protectionist. And one of the challenges we all have is that we all, as Americans, have a sense that things have moved against us in international trade, and so these great terms of how do you have fair trade and free trade at the same time come into play. But as one that's an advocate of freer trade agreements rather than less free, as long as there are reasonable provisions in them, I worry a lot that we could see the United States of America not learning the lessons of the 30s and leading the world in protectionism rather than free trade. And that could be very worrisome at this time. And in some ways, maybe more worrisome than in the 30s. Even though it was clearly an unhelpful phenomenon in the 30s. And that doesn't mean that you can't make some adjustments, but one has to do it very, very carefully. Now, in terms of other differences, finance is of a very different ilk, and both in terms of its worldwide nature, and then in the last decade, the beginning usage of instruments that we've never seen before. I mean, swaps and derivatives were non-existent at that time. And so you have greater systemic problems that come from technology. Now we have also, I mean, arguably the great inventions of the 20th century were, one, the computer, and then secondly, all of the software implications that can be applied to the computer. And in terms of that kind of technology, they didn't exist, although, as many of you know, the digital computer itself was invented in the 30s in Ames, Iowa. I just have to get these things in. Some people think they were invented at the University of Pennsylvania, which is not true. As a matter of fact, for all of you that are not historians of the subject, it was resolved by an appellate court that ruled in favor of a professor at Iowa State. But those things happen too. But I mean, everything about our societies are different, and then there are some things that are relevant. I mean, the studies of the 30s were that the Federal Reserve of the United States did not move to expand money supply. The studies of the 30s were that we allowed too many banks to fail. And so I think both of those are quite relevant in thought. And I think people are operating on those lessons.
We have time for one more question. Okay.
Do you have any comments on General Motors, in particular protectionism in that regard?
Excuse me, on?
General Motors, do you have any comments on that, the situation with General Motors or the automobile industry in general, and in particular with protectionism in that regard?
Well, at the moment, the General Motors issue is not being dealt with from a protectionist point of view other than infusions of United States government funds to help it, which has protectionist dimensions as a theory. But it's not, normally you think of protectionism as one of saying that we're going to put a high tariff on a foreign car coming into the country, or a restriction on the numbers of foreign cars. And to some degree, we've operated in that fashion. But it's also impressive to me how much foreign car companies are moving to this country. And one of their competitive advantages is they don't have the old line expenses of American companies operating here. My favorite prideful notion that I heard in an unlikely source was 5 or 6 years ago in South Korea. A South Korean top official was telling me that one of the South Korean motor companies was moving to the Deep South, and one of their reasons they were moving to the Deep South in America was that they would have lower labor costs than in South Korea. And that's a fairly astonishing thought. Now, part of it is that South Korea has very tough unions. And part of it is that they're moving to a place that wasn't as unionized, although they were going to pay wages well above the average American wage. But America, with the weaker dollar, is increasingly competitive in many ways. And so when you take Detroit, and you hear these statistics, and they get so large it's hard to know that the cost of every car is a couple $1,000s of it is healthcare costs. For companies that don't have to embrace the same kind of cost structures, that's for retired folk or whatever, that's a huge advantage they have. Well, let me just stop. By the way, I have put together, for anyone that wants to, a rather long talk on this subject with a lot of appendices that are very personal to me, but if anyone's interested in some of the history of legislation, I'd be happy to provide them that. Thank you.